Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alcana, and I have Timothy Hooker on the line, and he's an investment advisor at Dynamic Wealth Solutions. His mission is to help individuals reach their financial objectives by designing personalized plans. Tim, how you doing this morning?
I'm doing real well, Joel. Thanks for having me on. It's a pleasure. I
Okay.
love what you guys do at Benzinga. I'm a huge fan.
And you're a Detroit kind of guy, huh?
Absolutely. Went to Wayne State University, spent a lot of time in Detroit, and really think it's going to bounce back here after that bankruptcy ruling and a lot of good things happening down there.
I was a little bit worried about that, to tell you the truth, because it was an unprecedented move, and what now I'm looking at the future implications for other municipalities. But hey, we got it through in the D, so that's what I'm happy about. Tell us about your company, Dynamic Wealth Solutions, and kind of how you ended up at that level.
Yeah, Dynamic Wealth Solutions. We're a registered investment advisory focused on a local market here in Metro Detroit. I left the traditional brokerage firm mainly because we really believe in delivering fee-only investment services with the fiduciary principle. It serves our clients, best, and we really like to put others' interests first. And so we help people put together portfolios. We manage them, and we're really risk managers at the heart of it, and long-term investors, and really like to focus on the risk metrics like Sharpe ratios and keeping up with the standard benchmarks and helping people get to retirement so they can, live their lifestyle, go travel, and not really worry about what the markets are doing. And if there's an Ebola scare coming or something, they don't got to worry about that. We like to take the fear out of investing for them.
So how review going back to that Ebola scare and trying to provide comfort level with people. How did you handle that with your clients? Did you have some downside protection, and at the time were you a little bit more in cash, so you used the opportunity to enter some more positions? Because something like that is impossible to predict, and how the market's going to react to it is even more impossible to predict. And what's going to happen after the scare goes away is even harder. Tell us about, were you just positioned well in your portfolio going into it that, you could take the heat on the downside?
Yeah, we didn't really panic sell or anything. We were just long-term investors, and it was a real fast decline there, and it gets scary, and people, they'll call you and bounce questions off you, but really like to just stay long, and that's where our temperament comes into play, and help our clients stay relaxed, stay calm, and just focus on what they're doing in their lives. And definitely added some positions there when the markets came down, and they bounced back up just as quick. So it's definitely, you got to be calm and relaxed and not worry about the news too much when you're advising clients.
Do you use any kind of portfolio insurance, any kind of puts or sell call strategies or futures? Do you do anything like that so when a situation like that comes about, you're protected, or is that not part of your strategy?
Yeah, our strategy is really basic. We like to look at strong, world-class companies that are going to hold up in those kinds of market panic sell-offs. And companies like Walt Disney, Comcast, Home Depot, Amazon, those are the companies that we like to hold and provide safety with ETFs. So most of our clients all have exchange-traded funds, and we like to decrease the volatility with that and put together a portfolio that's diversified. So our clients aren't seeing these big swings in their portfolio. But we don't use any options, covered calls, and really stick to a basic game plan. But those are definitely things that more sophisticated investors take advantage of, and we definitely respect that.
Are you using the ETFs to simulate positions in the sectors, or are you kind of using the ETFs like the STS or some of the triple bears or something like that for downside protection?
Yeah, we'll use some inverse ETFs once in a while, but definitely look to low volatility ETFs like SPLV, and provide our clients with some comfort knowing that the volatility in these ETFs aren't going to be swinging like crazy when the market comes down like that.
Okay. When you were talking about some of the stocks that you were looking at, you mentioned, Walmart, and then you mentioned Disney, and then you threw Amazon in there. I mean, is that, does that stock really fit the criteria of a, kind of steady, safe stock? Or that just struck me a little bit funny when you said that.
Yeah, well, that's in the consumer discretionary spider fund that we like to balance out with our portfolios. But I will also throw XLP in there, AGG, some fixed income plays as well. And the ETF we love because you can get a basket of stocks, low expense ratio, and have a wide diversity for clients.
Are you invested in the U.S. markets, or do you dabble overseas as well?
Absolutely, we're heavily invested in domestic markets. We believe the United States is an outstanding company compared to the rest of the world. I mean, nation compared to the rest of the world, but definitely we'll have some international exposure. Right now, something like Germany is catching my eye. They had a good sell-off, and we think they're going to hold strong into the coming decade here.
Okay, so your clients are basically high net worth individuals and institutions, correct?
Correct.
Okay, so let's say I'm really unhappy with the current money manager that I have, and I come to you today, all day, of all days, with the market at all time highs, and I'm like, I'm tired of missing out on the market. Get me in, okay? What, at these elevated levels, are you still comfortable in putting someone in the market long term? Or would you say, hey, Joel, you need to sit down and relax here? If you're looking for the long term, there are going to be opportunities in the market to buy. You just don't come in. Because a lot of funds, if you go put their money, with some other money managers, you give them that $1 million today, boom, you're in the market next day. What would be your approach to me?
We take a dollar cost averaging approach. It's so fundamental, but at the same time, it's so useful because we're not jumping in a client's portfolio into something that is going to, be all in one shot. We like to do 25% investment in 3 months. Every quarter, we'll put in 25% and really allocate that diligently and focus on the sectors that are undervalued. Something like the gaming sector right now. I know Macau's gotten beat up, but the market vectors gaming ETF BJK, that could be something to watch in the future.
Okay, so you would just take a wait and see approach. It's not like you would say, "Hey, relax here. You need to, take your time getting into the market."
Definitely. It's an easy approach where we will put 25% of the portfolio in, laddered investment schedule, and really focus on asset allocation across about 6 different asset classes.
Do you ever tell people to sell, to get out of the market?
Yeah, I mean, it depends on their time horizon and risk tolerance, and if they're coming up to retirement age and they want to lower their risk to equities, we'll have them go into some more safe plays, municipal bond funds and CDs. But typically, the younger investors we like, who are 25 to 35, definitely stay long, stay focused on your career, and in 10, 20 years, I think just let the market do its job, and you'll be happy with that.
Okay, and boy, the investment industry has really, really changed over, let's say, since the financial crisis. I mean, you don't have a Bear Stearns anymore. You don't have Shearson anymore. You have your two big investment banks, and then you have your I guess your discount brokerages or your online brokerages. Let's talk about the RIA industry, and what does that offer the average investor?
Yeah, I think it's absolutely exploded since the market lows of 2009. According to a study by Schwab, about one-third of all firms have doubled their in revenue since that time, and with an emphasis on ethics and improving the overall standard of the industry. the fiduciary duty really comes into play. When you're working with an advisor who's going to put your interests first and make sure he's on your team, you sit on the same table. That's why I think the registered investment advisor industry is really growing, and it's taken a lot of money from these wirehouses, and they're having to go the independent route, as well as the automated investment platforms like Wealthfront. They take a fiduciary responsibility of your money as well, and they've absolutely exploded too.
And do you think that trend's going to continue?
Yeah, absolutely. In the next decade, I think we'll see a lot more investors coming to the fee-only side, and the money managers who are taking the fiduciary duty. The automated investment platforms, we love those, but at the same time, WebMD is similar to those. They didn't replace the doctor, and at the end of the day, it's all about that relationship and holding the client's hand when they're seeing these volatile markets coming down 10%. You need to be able to have a one-on-one meeting with somebody and really explain to them what their portfolio is doing.
Besides, you mentioned the gaming industry. Is there anything else that you're keeping an eye on that perhaps has not rallied back as much as the entire market, and something you're looking at just a little relative value may be a little bit more of a bargain? If you don't want to go into individual issues, you could just go to a sector as well.
Yeah, it's something that might be a little bit high risk, but the semiconductor sector, that got sold off and bounced back, but I mean we're very long on that as well. With technology growing, it's a hot sector. Transportation and technology, it's always going to be evolving, and it's going to be growing throughout the next 25 years here, and that's the kind of investors we like to deal with, who are going to be long.
And anything you think maybe got a little bit ahead of itself here that maybe if not continue, maybe not pulling back and going down, but maybe something that gains have just got a little bit ahead of itself.
Sometimes it's the biopharma. They're always fooling everybody. That industry is amazing. With the new technologies for healthcare, something like Exact Sciences that has just grown leaps and bounds. And it's hard to value those companies when they have new clinical trials and something like the PJP. You just have to look at the fundamentals, and something like Gilead Sciences is a quality holding.
Okay, and you pay much attention to technical analysis.
Yeah, definitely. That's something we look into when we're doing our laddered investment approach, and but it doesn't make or break our decisions.
Right, you more focus on the fundamentals, and then when you're looking for an entry point, maybe go to the charts and try and fine tune it a little bit.
Yeah, might wait a week or two till it really gets to that right spot, that sweet spot.
Okay, you've got a background in entrepreneurship throughout Metro Detroit, and you worked on some other early stage companies. Just tell us about some of your experiences from doing that.
Yeah, I spent some time with Cure Launcher. They're a life sciences company that matches clinical trials with their certain disease, and it's a really outstanding company. They've grown leaps and bounds. We're featured in Accelerate Michigan, awarded some angel investing capital, and I think they're going to be sticking around here in Michigan for a while. And that's why I'm long Detroit as well. When blood's in the streets, that's when you like to buy it up, as Warren Buffett says.
Okay, and if a lot of our listeners are not from the Detroit area, could you just give us a little bit of your overview of what's gone on in Detroit over the last 5 years, and has it surprised you, or not surprised you, and what are you looking forward to in the future?
Yeah, absolutely. I lived down in Woodward, right in Midtown there, for a couple of years, and when I got down there, there was a lot of vacant stores, vacant shops, and over the past 5 years, people have been moving in, taking chances, taking risks to open a business, and pop-up shops and different entrepreneurial incubators have been opened up, and a flux of money and capital has been coming to the city, and it'll take time, but if people take that risk, I think we'll see huge growth here. And I mean, we're right next to Canada, and it's a great spot to be.
Right, and I mean, you've had a couple, major investors, like Carmonis and Danny Gilbert and the Illages taking a big shot on the city of Detroit, and it appears to be paying off. Tim, before we let you go, just any final advice for investors here? Markets at all-time highs here as we're trading in today's session, coming into the end of the year. There's always do we have enough room for a Santa Claus rally?
Absolutely, that's a lot of objections we get from clients. Markets are always they're hitting all-time highs, and how do we get in when they're hitting all-time highs? And I think they're going to continue to hit all-time highs, and it's just about being diversified and prudent with your money. And I really appreciate coming on, Joel, and I'm a big fan of Benzinga.
Okay, all right. Tim Hooker, investment advisor at Dynamic Wealth Solutions here, talking about the RIA industry, his investment approach, and best of all, the city of Detroit. Did you get to go to that Lions game on Sunday?
I didn't. I was coaching a hockey team, but my
Okay.
partner did, and I love it. And the Red Wings as well. That new rink coming to town, that's going to be awesome.
Restore the roar. Okay, Tim, thank you very much.
All right, take it easy, Joel.